Hey everyone, my name is Dylan and welcome back to my channel. Today, we're diving deep into chaos theory and how it applies to financial markets. This is a crucial concept that can change the way you approach trading, so stick around because this one is going to be an eye-opening. From a human perspective, we constantly live surrounded by chaotic systems, or at least systems that appear chaotic because they are incredibly difficult to predict with precision. We often describe something as chaotic when we struggle to organize it systematically. Think like an animal population or climate change or maybe financial markets. These chaotic systems can be classified into two levels. Level 1 chaotic systems. In this type of system, predictions do not influence the outcome. The systems move forward independently, unaffected by any forecast. For example, if I try to predict tomorrow's weather, I can use meteorological models and data, but my predictions, whether it will rain or not, won't actually change the weather itself, so the system continues in its own, completely unaffected. Level 2 chaotic systems. Now here's where the things get real interesting. In this case, predictions do influence the system, meaning the system actually reacts to the forecast made about it. Take the financial markets, for example. If I predict that a certain stock will rise or fall and decide to act on that prediction, even if I just buy a single share, that action contributes to the market order flow. This in turn can influence other traders, creating a chain reaction that amplifies the impact of the initial prediction. And this is where chaos theory really comes into play. One of the first people to explore chaos theory was Edward Lorenz. While running weather prediction experiments, he discovered what we call now Lorentz equations. He noticed something fascinating. When an experiment was restarted from the middle instead of the beginning, the results changed drastically. From his work, we can extract three main characteristics of chaotic systems. First one, the sensitivity to initial conditions, the butterfly effect. A tiny change at the beginning can lead to massive differences on the future. This is where the famous metaphor comes from. A butterfly flapping its wings in Brazil can cause a tornado in Texas. The second one, determinism. Follow the rules, but it's unpredictable. Chaotic systems follow mathematical and physical laws, but their long-term behavior is impossible to predict precisely because of the sheer number of variables at play. The third one is aperiodic behavior. Chaotic systems do not follow a fixed cycle. They don't repeat themselves at regular intervals like a clock or a pendulum. Now, let's apply this to financial markets. Are markets random, or can we predict them? So financial markets are not purely random or based on luck. They follow rules and are deterministic, but because they involve millions of actors and actants, they become nearly impossible to predict in the long term. But then, what about the short term? So in 1814, Pierre-Simon Laplace introduced a thought experiment called Laplace demon. He proposed that if a hypothetical entity, a demon, knew the exact position and momentum of every atom in the universe, it could predict both the past and future with perfect accuracy. Now, let's apply this to financial markets. If an entity had a perfect and complete information about every market participant, every order, and every influencing factor, in theory, he would be able to make 100% accurate market predictions. However, in reality, this is impossible, because we lack perfect information. This means that while we can predict short-term market movements to some extent, after a certain point, predictions start to diverge, and the market becomes completely unpredictable. The key lies in determining the initial position of the trajectory, and that's what every trader is trying to do. The idea behind any trading system is to gather as many initial conditions as necessary to project future price movements within limited price range. The key condition is that The divergence between the projected and actual future price movement remains small enough that, when repeated with a consistent bias, the system maintains a profitable edge based on a percentage of winning trades and risk-reward ratio. Let's break down this concept visually. Imagine. The green line represents the real future price movement. The red line represents our projected price movement. If we enter a long trade aiming for these highs, and price follows our projection, we hit our take profit. But if we aim for a bigger price range projection, the divergence between our projection and actual price movement is too large, and we end up hitting our stop loss instead. This is the essence of chaos in financial markets. Since long-term predictions are impossible, the real key is the understanding of short-term predictability. Ask yourself, how does it align with your risk-reward strategy? A scalper and a swing trader will have completely different definition of what short-term means. The key is to find your own unique style and develop a consistent approach on your system. Before we wrap up, let's summarize the key takeaways. Financial markets are not random or driven by luck. The lack of perfect information is what makes traders lose trades, so accept losses as a part of your system. Your trading system should focus on short-term predictability, balancing between risk-reward and risk ratio, but remember, it's not the same one for everyone. If you found this video valuable, hit the like button and subscribe. Thanks for watching and see you in the next one.